Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the sometimes confusing world of corporate filings and help you understand what is really going on behind all the jargon. Today we are diving into an S-1 filing from Climate Transition Special Opportunities SPAC. Now SPACs can be a bit of a mixed bag. So let's see what is inside this one, shall we? This filing is an amendment, meaning they are updating their initial registration statement. This particular document is what is known as a preliminary prospectus, a sort of preview of what investors will see before a company officially goes public. It is dated the 4th of February 2026, and it tells us the company is looking to raise $150 million by offering 15 million units. So this is a fresh start for them. What is in these units, you ask? Well, each unit is a package deal combining one Class A ordinary share and 1/3 of a redeemable warrant. Think of warrants like options that give you the right to buy more shares later at a set price. This is key. They are a special purpose acquisition company, or SPAC. This means they are essentially a shell company with the sole purpose of raising money to buy another company. They haven't picked a target yet, but they have a focus: climate transition, specialty finance, renewable energy, and regenerative agriculture. So they are looking for businesses in these green and sustainable sectors. The plan is to buy one or more of these businesses and then merge them into this publicly traded company, and they are upfront about the risks. As with any SPAC, especially one that has not yet acquired a target business, there are significant risks involved. Let's look at the money side of things, or at least the plan money. They are offering these units at $10 each. Out of this $10, $0.6 goes to underwriting discounts and commissions. That means the company expects to net $9.4 per unit, meaning they will net $141 million before any other expenses. That money, minus offering expenses, is planned to go directly into a trust account. Here is where the trust account comes in. Around $150 million from this offering will be parked in a trust account. This money is meant to be used for the acquisition of a target business or return to shareholders if they can't find one. This is a standard SPAC structure. They also mention founder shares here, which are shares bought by the sponsor at a very low price. This can lead to significant dilution for public shareholders, a common risk with SPACs. Beyond the public offering, they are selling another 5 million warrants called private placement warrants to their sponsor and the underwriters. These are bought at $1 each and close at the same time as the public offering. It seems like a way for the insiders to have more skin in the game, and the clock is ticking. SPACs usually have about 2 years to find and complete a business combination. If they don't, they typically liquidate and return the money in the trust account to investors. This filing hints that extensions might be sought. Here is a big flashing red light in many SPAC filings: conflicts of interest. The people running the show, the sponsor and management, own shares and warrants bought at much cheaper prices. This means they could profit even if the company doesn't perform well for public shareholders. They have an incentive to get a deal done. Even if it is not the absolute best deal for everyone, they outline their acquisition criteria, including scalable growth, visionary leadership, valuation rigor, sustainable competitive advantage, and solving high-impact problems. They want businesses that are not just growing, but also have a strong foundation and a clear path to success, particularly in their target sectors. But remember, they haven't picked a target yet. So these are just guidelines. Let's look at the team. Robert Zorkowski, the CEO, has a massive amount of experience, spanning over 4 decades and billions deployed. He's been involved in impact investing and has held senior roles at Oaktree Capital Management and founded Pangea Capital Management. Clearly, a very seasoned finance professional, Andy Childs, the CFO, also brings extensive financial and operational scaling experience. The director nominees, Emily Krebs and Cheryl Schwartz, also have impressive backgrounds in ESG, finance, and institutional investment, which aligns with the company's focus on climate transition and impact. Gary Julian also has a strong M&A and investment background. They also list the past SPAC experience of their team members, like Cheryl Schwartz's involvement with Cartesian Growth Corporation too. This gives investors a look at their track record, although past performance, as they rightly point out, is never a guarantee of future results. The filing paints a picture of massive market opportunities in climate transition, specialty finance, renewable energy, and regenerative agriculture, with trillions of dollars expected in these sectors. However, they also acknowledge the challenges like capital constraints, rising interest rates, and policy uncertainty. which can make even promising ventures volatile. They specifically mention the impact of reduced IRA incentives on clean energy projects, highlighting the real-world challenges these sectors face. When it comes to picking a target, they are looking for companies with sound fundamentals, but may be struggling to raise growth capital due to market volatility or those facing financial distress, but with clear potential for improvement. They explicitly mention deep value investing and special opportunity companies. This means they might be looking at distressed assets or companies that are undervalued. Now, let's look at the deal itself, the offering details. As mentioned, 15 million units at $10 each. The underwriters get a $0.6 per unit discount, leaving $9.4 per unit for the company. Of that $0.6, $0.2 is an upfront payment, and $0.4 is a deferred underwriting commission, meaning the underwriters only get that part if the deal closes successfully. This is standard practice to align the underwriter's incentives with the company's success. This highlights the trust account again. $150 million is earmarked for that account. About $1.275 million is left over for general operating expenses, legal fees, accounting, and other costs associated with finding and closing a deal. This is a crucial point for dilution. The sponsor bought founder shares for practically nothing. This means that even if the company's stock price falls significantly, the sponsor can still make a large profit. This is a major concern for public shareholders, as their investment could be heavily diluted. Let's look at dilution. If no shares are redeemed, the net tangible book value per S-share appears to be around $9.6 after this offering. But if many shareholders redeem their shares, that number drops significantly as shown in the tables. The difference between the offering price and the net tangible book value per share is the dilution, with founder shares being so heavily discounted that dilution is substantial. For their financial statements, prepared as of the 30th of September, 2025, they report a net loss of over $45,000. This is expected for a company that has just been formed and has no operations. The key takeaway here is that the bulk of their activity is in preparation for the offering and searching for a business to acquire. They reiterate their mission to leverage their management team's expertise to find opportunities in climate transition, specialty finance, renewable energy, and regenerative agriculture. Their team has a strong network and experience in these sectors. The risk section is extensive, as is typical for SPACs. They cover risks related to not finding a business combination, shareholder redemption rights, potential dilution from issuing more shares, regulatory hurdles like CFIUS reviews for targets in the US, and the general market conditions affecting SPACs. They also highlight the risk of becoming an investment company under the Investment Company Act, which could lead to burdensome regulations. This point about dilution is hammered home. The difference between what the sponsor paid for founder shares and what public investors pay is vast. This means the sponsor has a significant incentive to complete a deal, possibly even at the expense of public shareholders if the deal isn't ideal but generates a profit for the sponsor. CCM is acting as the book running manager. They stand to earn underwriting discounts and commissions, including deferred ones that are paid only if the business combination closes successfully. Greenberg, Traurig, LLP, and Appleby Cayman Limited are providing legal counsel for the deal. Their auditor, Withum Smith Brown, PC, notes substantial doubt about the company's ability to continue as a going concern if they don't complete the business combination or secure financing. This is standard for pre-IPO SPACs. So, what is the overall story here? Climate Transition Special Opportunities SPAC is aiming to capitalize on the growing interest in sustainable and climate-focused businesses. The management team appears experienced and the market opportunities they've identified are certainly significant. However, like most SPACs, the risks are considerable, particularly concerning shareholder dilution from founder shares and the potential for conflicts of interest among insiders. The success hinges entirely on finding and successfully integrating a suitable target business within their 2-year window. The financial tables show pre-operational expenses as expected for a company at this stage. Investors should carefully weigh the significant dilution risks against the potential upside in sectors like climate transition and renewable energy. Alright, that is our breakdown of this SPAC filing. What is your take on these numbers and what they signal for the company's future? Do you think their focus on climate transition is a winning strategy or too risky? Drop your thoughts in the comments below if this analysis was valuable. Hitting that like button really helps the channel grow. And remember to subscribe for more deep dives into corporate filings. Don't forget to check out our Discord community linked in the description for more discussions and insights. Thanks for watching. See you next time.